Hi, everyone. I am Rick Bensignor. Today is Tuesday, March 24th, and this is In the Know Trader. Well, as we speak and record late morning, the S&P is up about 165 points. On the highs of the day, we've just crossed above 2,400, and we're finally seeing a significant move higher. We will talk a lot about this bounce now and whether or not I think that the low that was posted yesterday has any legs to being a low. And we'll also take a look today. In fact, here, let's kind of move forward. Let's start off how to contact me. Rick at inthenowtrader.com is my email. Thank you for all the continuous emails we get after doing these shows. It is so nice to hear how many people I help trade better with the information I give in the show, and of course to subscribe, and many of you end up becoming subscribers. Go to our website, www.inthenowtrader.com, and you can find out plenty of information there, videos on TV interviews. In fact, I'll put up yesterday's Bloomberg TV interview. I was on for a half hour yesterday on Bloomberg. So we will put that up on it too. And of course, it gives you information on how to become a subscriber. So today in the show, we're going to take a look at the S&P like we do. Well, I'll also give you a look at the Dow Jones. And normally I don't look at the Dow Jones. I've told you guys many times that it's not an index I pay close attention to because the institutional community does not. But I want to show you something very important that I saw on the Dow chart. And then again, just because the world's still in this kind of crazy mode, instead of focusing on a particular sector or something, I want to give you a good macro view of what's going on. So we'll look at the US 10-year, gold, oil, and the dollar. And then if we still have time, we'll get into some specific widely held stocks, including the Mafang stocks and a couple of banks, and maybe even Boeing if we have time. So let's kind of get into the thick of things here. We're going to switch to our charts. We'll start with the S&P. And here's what we see. So last week we started doing some buying. For those of you who watched yesterday's Bloomberg interview, and I posted it also, the link to it on LinkedIn, and those of you who follow me on Twitter, and even, well, yeah, those are the places that I've put the link. And of course, you can go to Bloomberg.com and pull it up there. It's on the Daybreak America show dated March 23rd. So as I mentioned, I was on for about a half hour. So we talked about several topics. Very few of them what we had actually planned on talking about, but because of the news of the day yesterday of the Fed injecting and coming up with the plan that they did, that was really the main conversation of the day. So we talked a little bit about markets, but instead of talking about gold and oil and some of the things that we were going to talk about, it really just stayed focused on the equity markets, as well as everything that was kind of going on in the world. When we look at the S&P chart, we started doing some more buying, and what I've suggested to you, if you've followed my show over the last several weeks, is that I'm looking to do kind of pyramided buying, such that the more we fall, the bigger the size you buy. And you still have to, I still have plenty of powder left for deeper decline if it comes. But I think of this as kind of pyramiding, so that let's just say for round numbers and argument's sake, let's say if I found a reason to be a buyer at S&P 2800, let's say I bought 1 unit worth of, or a certain amount of dollars worth of spiders at that point. If I wanted to buy more at 2,500, I'd be buying more than 1 unit. Maybe I'd be doing 1.5 units. And if we fall more, so in other words, the more we fall, the bigger the size I want to buy, on the assumption that over time, that's the smarter way to get into something if you believe long-term in the market, as I do. Now, do I think the American market is still probably the best market in the world? I do. Is this coronavirus going to absolutely destroy corporate earnings for the second quarter and probably the third quarter? It will. And so this is going to take a while to recover. And it's way too soon to knock out of the equation the chance that this could turn into a deep recession, if not possibly a depression. And I'm not one of these people who goes for, I can't think of the word, but I don't go for theatrics. The talk of me using the word depression a la 1929 is not out of the cards. We simply don't know. And depending upon how quickly we can get a handle on things, how quickly people can get back to work, which could be weeks or months, we just don't know. How fast corporations can start growing again instead of losing money hand over fist, is going to determine a lot in the future. And it's possible, it could take years to recover from this. We just don't know. And I'm not about to tell you that I think later this year, we're going to make new all-time highs. I have no way of knowing. And anybody who tells you that they know is simply lying to you and trying to be a good salesperson to sell their product, because nobody knows anything right now about how the markets are going to move and how the corporations are going to do and how the country is going to do and how the world is going to do. We just don't know. What we can do is try to make educated guesses at where are logical places to put some money to work, in the hope that things don't completely fall apart. But I know that any dollars that I put into the market now may very well take me years to recover, because I simply don't know. So by the time you think it's safe to come back in, because all the headlines have turned positive, and the virus has, at some point in the future passed us by, and people can come out of their homes and go back to work, and companies are starting to grow, the market will have discounted that well before you have any real safety signals here. You can see on the way down how fast the market realized what this was going to do to corporate profits. It will realize that on the way back up, whenever that happens to be. And if you wait for the all clear sign, it's too late. So it means you do or should do some buying on the way down, but with the full understanding that it could take a heck of a long time for this to play out. So, you allocate your money depending upon those considerations as you kind of think about investing again. So on a shorter term basis, here when we look at the S&P, you noticed over the last week we got an aggressive sequential, actually that's an aggressive combo 13 signal suggesting downside exhaustion. I'll show you here with my, here, let's make this more of a pointer. So this area in here, so that's, I guess I say about a week ago, we start getting downside exhaustion signals. Yesterday, the low was made, sorry, excuse me, against a near-term propulsion exhaustion level, just giving a little more credence to a potential low. Plus, yesterday's low got very close to these dotted lines here, which is the stop out on 13, which is, you can see at 2180. So if we properly break under 2180, and it's not just an intraday move, and it's not just necessarily a close, it's how we do it, then that would say that this 13 is no longer active and looking for potential downside exhaustion. The fact that we got very close to it and it's bouncing as strong as we are today is a good thing. Upside targets from the low yesterday. So if we take some trend factors on the way up, you've got 2422, right now today's high is 2407, so a little bit above today's high. There's a propulsion exhaustion level at 2477 and another trend factor up at 2543 and so on, but those are kind of the ones close by. The other thing that's important is amongst all these lines and things I have here is this magenta colored line, which is part of the cloud chart. And you'll notice that, and just so you know, the calculation on this is it's the arithmetic midpoint of the last 9 trading bars, including the current day. So we would look at the current day here. This is one bar 1, 2, 3, 4, 5, 6, 7, 8, 9. So it's going to find the highest high, which happens to be this day's high, the lowest low, which was yesterday's low, add them up and divide by 2. So it's the arithmetic midpoint of the last 9 bars, including the current day. And for a couple days now, if we don't take out yesterday's low, this level will actually stay here because 9 bars ago is this day here. And it's 8 days ago that the high was made. So even tomorrow, this value here at 24.52 is going to be where the midpoint is. And is this important? Well, generally, in a strong trend, this line represents first resistance. And you'll see back up in here. So after we topped and we sold off and we stopped at one of the trend factors down, we rallied and stopped right against this pink line in here and sold off again. And that pink line again, or magenta colored line, is the conversion line. So there may very well be some resistance here. If we blow through it, any one of these levels or potential targets, notice that the full propulsion exhaustion level happens to be very close to the second line in the cloud chart, which is here in orange, called the baseline. So this 27, this high 27, just south of 2,800 level, is also a potential bigger target and a place that I might very well lean into on the sell side to take off some exposure if we get there. It all depends when and how, etc. But that's the look at the S&P to start things off. Let me show you a different chart that I think is rather important in the scheme of things too, in trying to figure out, was yesterday's low significant? Well, according to the S&P, yes, because we stopped against the 13 stop out level and bounced sharply. So at least for the near term, we have a defined level of about 2180. That's fairly important. Let's look at the Dow. The Dow got an aggressive sequential 13 yesterday. So whereas the S&P had gotten it back several days ago, this came in yesterday. In addition, unrelated to this 13 signal is a different way of measuring and using, let's say, Fibonacci retracements than most people are accustomed to. And this was developed also by Tom DeMark. And most of these models you look at that I show, not the cloud chart, but many of these other ones are models developed by Tom DeMark. And these are institutional models that I've been using this since 1995. So there aren't too many people on the street who have been using DeMark models longer than I have. There are a few, but not many. And one of the things I know too is that when you have, when you're trying to do a Fibonacci retracement from an all-time high, and this here's the all-time high in the Dow, back here in February, DeMark said you really cannot pick. Let's see if I can do this. Like here, which low would you pick to do a Fibonacci retracement from? I mean, this looks obvious from this December 2018 low. Clearly, it was a significant low. But what he'd say is that's still an arbitrary choice because maybe somebody else would have picked, let's go back further, maybe this low in here in 2016, they would have taken this low versus the all-time high. So even though this one here in December of 2018 looks obvious, what he's saying, and I think he made a very good thought process in doing this, is that it's subjective, right? You pick this, you say, okay, it's a major low. And what he says is that when you're measuring from an all-time high, you don't know which low to use because it's completely subjective. Therefore, instead of picking a subjective low, literally take 0.618 times that close that made the all-time high. And if we do that with a minor adjustment simply because the day after the all-time high gapped lower, and therefore we're going to take it from the close of that day instead of the all-time highs day, take 0.618 of that level, and if you multiply that close at here, 29,423 times 0.618, you get 18,176. Yesterday's low, 18,213. Darn close. If I spread this out, you'd see it didn't quite touch it, but we got something like 50 Dow points away. 50 Dow points means nothing now. That's a breath. So when I was on TV yesterday, this is part of the reason I suggested buying. And so we took advantage of yesterday's weakness and bought and have a rather significant update today. Now, we're up against some potential resistance right now in the Dow, but let me show you something else and why I think that even if we pause here, we're probably not done for good on the downside before. At some point we'll have another wave down, or we'll likely have another wave down. But for now, let me tell you why this is potentially the bottom for a little bit of time. One of the things DeMark did too is figure out how to draw trend lines automatically. And again, taking away all the subjectivity to which 2 points you should use to create a trend line. And when, so these are called TD lines, Tom DeMark lines. When trend lines break, the software can also give you targets for them breaking. So every time we get a solid blue line, that, let's say, breaks, it told you that when we broke here, we'd go to this. When we broke this line here, we'd come down here. When we broke this uptrend line, we'd get down here. We actually did, and we gapped through it. When we broke these lines here, it would go here, etc. This is the first time we're breaking an downtrend line to the upside since this down move was made. And what it says is that by breaking above it today, we target 21,198. That's where it says we're going. Now, by chance, there's a trend factor at 21,251. 50, again, roughly 50 down points above. So getting through here, where we're kind of trading right now in the next couple of days, as long as we don't sell off about 5.5% from any high, says we're going to about 21,200. So that's what I'm playing for here on this trade. And at that point, I can reevaluate if I want to still hold the longs that I've had. I've bought a little higher too, so I may take some off here, and again reevaluate and see what to do. But this is why and how I'm often getting clients into moves at the turns and not waiting like most other technicians for moving average, MACD crossovers, or an RSI to get oversold and then to get, bounce out of it. And let's just take a look. So here, if I put up RSI, you got way oversold in, looks like February 24th breaks into oversold. You come out of oversold right in here. So basically you bought the top of the move. You had one day to get out, which you would not have done and wouldn't have known to have done before we collapsed again. I am not a fan at all of using most oscillators like stochastics, like RSI. When you have a dominant trend, these will kill you to use if you're going to try to fade the trend. The best times that they're there to work for you in a trend is to play the direction of the prevailing trend when the oscillator gives you a signal to play in the direction of the trend. So for instance, if we move up enough for the RSI to get overbought in what clearly now is a downtrend, well, that may be very helpful in helping time when to sell into the rally. But using an oversold in a market that's crumbling is not a good idea to be a buyer. So you also have to know when to use different indicators depending upon the mode that the market's in. And one of the lectures I give, and I think it may even be up on the No Trader website, I'm not 100% sure, is about the 5 tools and the 5 steps you need in order to properly analyze markets. And one of those steps is making sure that the indicators you use match the mode. Match the mode that the market's in. So if you're in a trending mode, you don't want to be using oscillators except to get a signal in the direction of the prevailing trend. If you're in a sideways market, oscillators are great. They usually line up with the overbought and oversolds in a market that's really spinning its wheels and going nowhere. Then you can trade those shorter term moves. But in something like this, I'm not going to really give any credence to what an oversold signal is going to be in a market that's falling apart. In fact, here, let's look at it this way. If we look at how many times you're overbought, if you sell every time you get overbought in the market, you don't do well in a market that's been trending higher. But if the times you get oversold or near oversold are almost always the good times. So again, use oscillators carefully, depending upon what the market's doing. All right, let's take a look now at, let's look at the 10-year TNX on a weekly chart. So this, we told you also a couple weeks ago, was likely going to be the near-term bottom. I used an Andrews pitchfork from the 3.25% high, drew the pitchfork, and because we were at the outer tine, T-I-N-E, tine, like each one, when you have a fork, each or dinner fork, each one of those prongs that stick out is called a tine. So we were at the lowest kind of extreme tine on a weekly setup 9 count, and that to me was the blow-off move. We then came back. We actually got to about 1.25% or so and pulled back, and now we're back to 86 or 87 basis points or so. So this should spend some time kind of getting closer to, now that we've had a blowout move to the downside, this should spend some time kind of hovering on either side of the middle tine, which is this black line in here. So I expect us to kind of go back and forth here as there's still a fair amount of volatility. And for now, I don't see a reason to get back down to 40 basis points. And of course, this is TNX. TNX only calculates in the hours that the New York Stock Exchange is open. In reality, the 10-year got down to 30 basis points in actual trading. It just didn't, it took place overnight, New York time, and therefore it didn't show up in the TNX. And if I remember correctly, too, last week in the No Trader, our weekly piece, we actually had a play out in bonds, which I believe we got into. So so that's my view on bonds right now. And look for also here, take a look at that pink line, first resistance. We went through, we actually intra-week went above even the baseline, but then closed down. So you're still going to find something in and around this middle time, which is just, I don't know, about 105 basis points, something like that. But on a spurt up, it's very possible that we could test up here. Do I think we get back to 1.5%? Probably not in the near future. And if we did, that's really where the breakdown came from, right? So we had, remember, anywhere from like 1.45% down to about 1.35% were the all-time lows that we finally cracked through. So anything in and around that level too, once you get north of 1.4%, you start getting into the bigger resistance. Let's take a look at, what else do we say we would look at? Oh, gold. So here's actual gold. So gold had a 13 right near its high, near 1700, 2 days before the high of the whole cyclical move. Gold had an exhaustion signal. 1700, I think I have it maybe here on the weekly chart. Let's see, here's a weekly gold. Right, so this green line here had been my target. If you, again, I've mentioned this a few times before in other podcasts, but or other shows, I'll mention it again. If you look at the 6-year rounding bottom in gold and take the approximate range of 1375, where you had multiple highs, down to approximately 1,050, that's $325. that this thing traded back and forth in. Take 325, add it to this 1375 breakout level, that comes to $1,700. And look at where the high of the move is, right? The high is 1704, and then it fell a couple $100. We, my institutional clients, I got back into gold at 1455 average price last week. And I think I even mentioned it on the show last week that I had bought gold down there and told you that I liked gold. And, you know, we're seeing a very strong up week that essentially challenged those highs. We've pulled back on a massive range day. Let me see. Right now, I've got gold as a high. April gold today, 1698. The low is 1563. So about $135 range in gold. That's over, or I don't know what's that, about 9% or something like that. If gold can take out the highs, then this should give you a move that next would target 1740 or so. And, you know, this rounding bottom is really significant. So the fact that we came down and we didn't test where it broke out from, but we got down to the propulsion exhaustion level, it's turned around and come back, you know, I'm holding on to my gold here. And one of the things that might have spread around the street yesterday, because in my Sunday night report to institutional clients, I took a look at what gold had done in the Depression days back almost 100 years ago. So I looked from like spring of 1929 to the spring of 1934. Gold doubled in value in inflation-adjusted terms. So I said, if you have any concerns that we're going to be in a deep recession and/or depression comes from all this corona mess, then you really want to be long gold. And I don't know if gold just exploded yesterday and today because of that note going around the street or not, but you know, we're back over 1650. We've again challenged here, and there's a big range here, so traders may, you know, try to play within this range, but if you think things are going to get real bad, you do want to have gold as part of your portfolio. Oil, I'm going to skip. It's not enough of you trade oil. So let's see if we have, in a few minutes here, if I can just get to, let's see if we have anything that I can get rid of. Nope. Oh, here, let's take a look at this, by the way. This is a chart of growth versus value. And you'll remember last fall, many analysts on the street were talking about this is finally the time for value. And in this ratio, this is IVW, which is the ETF for growth versus value, IVE. You saw value outperforming for months, you know, from the summertime into the fall. And right in here is where I said, I don't think this thing is going any lower. And growth has come back remarkably. So if you look at large cap growth versus large cap value, you see that this has been just explosive in growth. So there's still no value game out there, at least on the large cap side. I don't know about the Russell 2000 growth versus value, but in S&P 500 growth versus value, this is still a massive growth type outperformance. And I haven't done analysis on this to see when I would expect it to run out, but it's the street got that way wrong. That is actually our show for this week. So I am Rick Bensignor. Thanks for tuning in.